Welcome to another episode of Founders Club. Today we're going to be talking to Grant Reaves, the co-founder of Stoic Equity Partners, and we're going to be having a cool conversation about some of the unique things that he's doing in the real estate space. So really excited and look forward to jumping in. As always, guys, check out the links in the description below. And if you like money and you like real estate, hit that subscribe button because this is the show for you. We'll see you on the inside. Welcome to Founders Club, the show for real estate entrepreneurs. And Grant, welcome to
How's it going
Founders
today?
Club.
Thank you for having me.
So, I want to talk about some of the unique things you're doing with the flex industrial projects and things like that, because I think it's really interesting and you're in some kind of unique opportunities. But before we get into that, why don't you just give us like a quick background on how you got into that side of the business?
Certainly. I'm currently located in Alabama. I grew up in Georgia and went to Auburn University while I was in college. I didn't really have a whole lot of direction, didn't really know what I wanted to do. About my junior year, my parents were like, trying to, have to find some direction. So through that, ended up working for a home builder who suggested I get my real estate license. That is how I ended up in residential real estate for about 6 months and quickly gravitated to commercial real estate brokerage. So I guess I started in that when I was about 21 and sold primarily limited service hotels throughout my brokerage career. Started out with kind of a regional firm, then with Marcus & Millichap in their national hospitality group, and had a great fun doing that and sold a lot of like Hampton Inns, Holiday Inn Expresses, all the flags throughout, but primarily in the Southeast. And through that, learned how to underwrite deals, how debt and equity were kind of put together, and how to put deals together to a certain degree. I mean, obviously, as a broker, you're a little bit more on the outside looking in, but always wanted to get on the principal side. So, as a broker, I guess this would have been 2020. Obviously, hospitality brokerage was not doing well going into COVID, and my now business partner Jeremy Friedman, who is a fellow broker as well, as an old friend, he called me and we were just kind of catching up, and I had been looking at starting to do some syndications and raise some money and do my first deals. And he actually had an idea on a building here locally. And fortunately, I've been kind of working on the deal structure, legally setting up the GP/LPPs, how to underwrite, how to put models together, that kind of thing. And so we kind of had an idea for that first building in 2020, and that's how Stoic was born. So we founded the LLC, I guess, in June 2020, did our first deal about a year later, really. So that's who we are. And so we started off in the self-storage game, did 4 self-storage deals, and now we do multi-tenant flex industrial throughout the Southeast. And currently own about, I guess, 900,000 square feet. So it's good.
That's great, man. Very cool. So you got straight into commercial real estate side of things.
Yeah, I did. I say that. I mean, I sold houses for probably like 6 months, and
Right.
it
Okay.
wasn't,
Yeah.
wasn't the right fit for me. The residential game's great. I mean, people kill it. Just I was trying to figure out something else, and met a guy really who was a mentor of mine for a long time named David. And I guess I met him when I was 21, and kind of told him, "Hey, I want to be in commercial real estate." So I kind of started with him as his cold caller when I was in the young 20s, and kept just kind of moving up, doing more and more deals.
That's great. Yeah. What a great way to get in, right?
Yeah, for
Um,
sure.
so cool. So now, fast forward a little bit, you build up your experience in the commercial brokerage side of things, and now you're doing something that I think is really interesting and unique, calling it flex industrial. So why don't you tell us first what that is, and then we can kind of go a little deeper on it.
Certainly. So obviously, industrial real estate, a bunch of different ways of warehousing and logistics and manufacturing space. There's a lot of different things within industrial. Flex industrial, some people also call that kind of a shallow bay or class B industrial. But it's essentially, the way we look at it is, it's a multi-tenant building made up of multiple office and warehouse suites. So this might be a 50, 100,000, 200,000 square foot building or complex. It's made up of a bunch of 3, 4, 5,000 square foot office suites. We really prefer the stuff that when you're looking at it, almost looks like an office building, like a single story garden style office building. But on the rears has roll ups and dock highs. And so those suites will have a varying degree of office to warehouse. So you might have if it's a 5,000 square foot suite, you might have 1,500 square feet of office with the remainder being warehouse. And that's what we do primarily in secondary cities in the Southeast. We don't really invest too much in the tier ones or the really high growth markets. So like we don't play in Nashville, for instance. Like it's a great market. It's just kind of a different investment strategy than what we play in. We look for a little bit more in place yield. So we end up more in like the Memphis, Tennessee than the Nashville, Tennessee kind of thing.
So when you're out there looking around, what is it that you're looking for to be a good fit for this type of thing?
First off, we need upside. So we're a value add firm. So we're not your stabilized 7 cap buyers that are just going to hold something and clip coupons for a long time. We need to have some upside. So we buy a lot of times from kind of more legacy owners. So kind of retirees, people that are getting out of the business. Maybe they built it. We bought a deal a couple weeks ago in McDonough, Georgia, which is kind of near Atlanta. And it's 90,000 square feet. It was built in the late 90s by, I think it was 3 partners. They're now in their mid 80s. They're looking to retire. They had in-place rents of just under $5 a square foot. Market, and that's modified gross, market's 12 triple net. So a lot of upside there. And so we look for those kind of opportunities where it's somebody who maybe is 100% occupied. They're clipping coupons because their basis is so low because they've owned it for 30 years. They're doing pretty well. But we can go in, do a little bit of retrofit, a little bit of renovation, and market the rents to market and realize that upside.
Okay, yeah. So you're looking for mom and pop kind of owners that
Yeah.
are doing like napkin P&Ls and things like that.
We do some of
Val
that. We do buy from some, I will say, more sophisticated guys. And what we find on that side is more so just people that maybe have other projects going on. They don't want to come out of pocket and renovate these. And a lot of times those seem to be the properties we buy that have too much office space in them. So obviously office is not as in demand as it was at one point. So, but let me back up, like 15 years ago, a lot of these are like 80s, 90s vintage construction. But like over the past 40 years, somebody has gone in there, built out a suite as 80 or 90% office and has very little warehouse. Well, that suite's probably sitting empty these days. So we've bought stuff that's in the 70s, low 80s occupancy, gone in there, ripped out a bunch of office, turned it back into 50-50 office warehouse suites, and been able to run up occupancy, kind of run to that value add strategy as well.
So it sounds like that's the main model. It sounds like you're buying value add opportunities and you're converting things that are more heavily office and converting them back to more 50-50 style or even potentially more industrial warehouse.
Yeah, it's a little bit of both. And so it's kind of one of the other strategies. So it's either buy something that's the right breakdown of office to warehouse and just has really low rents and just need to mark those to market, or it's a strategy of going and buying something that has low occupancy that you're maybe not even raising rents, you're just filling up vacancies. Just a little bit of both. So it's kind of one or the other. But I would say it's about 50-50 either.
Okay, cool. And on these conversions that you're doing, talk to me about that because I do think that's very interesting. Like you said, the demand for office is not what it once was. I think people are looking for creative solutions in that space. So, what is it that you guys are really doing to kind of convert these buildings?
Yeah. So they were all built as flex originally. So these aren't like true office buildings that were built as office. They were built as flex industrial.
Okay.
But back in the 80s, 90s, even 10 years ago, there would be a blended rate on stuff. So you would have like when they would advertise a rate, it would be like $12 a square foot for the office, $7 a square foot for the warehouse, just because of how cheap the warehouse space was. So that's really when you saw the office start to get built out more. So like, for instance, I'll kind of quick deal story. I bought a deal in Ridgeland, Mississippi, 56,000 square feet in November of 22. It was 74% occupied. And it was exactly that. All the vacancies were essentially just all office. And so it has, in the warehouse space, it has double doors and kind of like a grade level door there. And so it would just go all the way back into the warehouse, just completely office. So the prior owner was wise and went in there and had like 2 units that were like his example units, but he went and put in 50-50 office warehouse and leased them up immediately. And so kind of showing up. So kind of like multifamily, I think that Oliver, you have a decent amount of multifamily. You see that in that space where like a group will go in, buy a deal, renovate like a third of the units to show the upside, then sell it. It was kind of one of those deals. He was kind of like proving the model. But for instance, we bought that deal as 74% occupied. in the past 18 months, we've now brought it to, I guess, 94, 95% occupancy by pulling out that office space. But again, it was originally built as flex. It just has gotten built out over time as more office. But you see it a lot, and you'll even see it sometimes. You can look at some buildings. We haven't bought one like this, but we've looked at them where it looks like it's just a bunch of glass on the rear, but really that's just glass over dock high doors or grade level doors. So somebody took out the roll up door, put glass over it, but those can be converted back over time.
Yeah, so it sounds very similar to like a multifamily model where you're coming in looking for value add deals and then doing something to kind of get it rented up, right? Whether it's
Mhm.
renovating existing stuff or converting it to something that makes more sense. But I do think that's really smart and a good, kind of like sub niche
Mhm.
because there's definitely not a lot of people doing what you're doing right now.
Yeah, and you can't build it. That's really our biggest thing, and we talk about this all the time. So people that follow our content are probably tired of hearing that, but that's really the biggest thing about it is that current rents don't support new supply coming in. Average rents in the markets we play in are $8 to $12 a square foot. To build is about $140 to $160 a square foot. So you would have to be at 15 plus rental rates. So I mean, there's a real delta there that the market's going to have to achieve before new supply comes in. I do think that you are starting to see some new construction come on in kind of the tier ones, which that's kind of how it goes, right? Like you see the big markets start to build, then it goes to the smaller markets over time. So I think you'll see new supply eventually come in, which will be great for us because it'll mean that rents as a whole will rise throughout the market, including ours.
Yeah, yeah, absolutely. I think that's a good thesis you have there.
Yeah.
So talk to me about how you guys are finding deals right now. What are you guys doing to find deals?
Yeah, so Jeremy, like I said, was a broker as well as I, and so we had really deep roots in the brokerage community throughout the Southeast, and so we've identified, I'd say, 12 markets that we really like to play in, and have made sure to go out, find the brokers that are running with Flex in those specific markets. So in Jackson, Mississippi, there are two main brokerage groups there that lease, manage, and sell the Flex Industrial there in the Jackson, Mississippi metro. So we've got to be really good friends with them. They know exactly what we're looking for. We'll go in. And so when we go into a new market, we will find those brokers. So whether that's one or two or three brokers, it's usually one or two. We'll go and database the whole market of all the buildings we would like to own in that market. And then we send it to those brokers. It makes our lives a lot easier. We don't have a team of cold callers out there trying to make relationships with building owners just because at the end of the day, the brokers already know these guys. So it makes the sell so much easier rather than me trying to cold call owner Bob and convince owner Bob that I'm legit and you should sell me your building. This broker can call Bob and they talk to him once a week anyway and say, hey, these guys from out of town are looking to buy Flex. And that really has been able to keep our deal flow very robust. Because also at the
Yeah,
same
that
time, those brokers are going to get the leasing, they're going to get the management, and eventually the sell when we dispose of this asset. So they have a lot of motivation to bring us stuff too. So
yeah, that's smart. And again, very similar to the multifamily playbook. If you can get to know the brokers that are the movers and shakers in that space, in that market, you're gonna automate your deal flow.
exactly. It makes it a lot easier. You talk to some groups, and a lot of people do really well at it. And everyone's model is a little bit different, but there are some teams that are out there. I feel like they're just cold calling the world, trying to find off market stuff, and it's not really cost that much more to go through brokers, in my opinion. And you get a
Yeah,
lot more
yeah,
local knowledge doing that too. I mean, it's not like we're pretty geographically diverse, so you need to have boots on the ground and people that understand. Like, you don't really want to go in that part of town because of this, or you do want to go in this part of town because of this new development. It's good to have that local knowledge.
yeah, absolutely. I think that's invaluable. And to your point, they are talking to them anyways.
Exactly. Yeah,
Yeah.
they might already manage it, or they have managed it in the past, or they run into them at the grocery store. I mean, real estate, even in larger markets, it's amazing how small the world is in the world of real estate, right? So
Mhm.
they all somehow know each other. So it just makes that sales process so much easier. And they already have trust. So if they know if that, like one of my brokers, BB, they know if BB's bringing them a client, they're like, well, BB knows these guys. They must be legit because I know BB and BB's legit. You know what I mean? So it
Yeah.
helps out a lot more
Yeah.
on credibility as well.
Very cool. So then how are you guys putting your offers together? Is it just, you're trying to buy at X% below market, or what's your strategy in terms of how you're submitting offers?
Every deal is a little bit different. So obviously it depends on how much meat on the bone. And one thing that we really run into in flex industrial that you don't see as much in multi, like multi, you have pretty much everything is year to year leases, right? So over, let's say 2 years, you can roll 100% of that rent roll is my understanding. I don't do any multi. That's just kind of my understanding.
Hmm.
In flex, you end up where these are 3 to 5 year leases, sometimes a little bit longer. And so you want to
Right.
be really careful that your WALT, your weighted average lease term, isn't too long, because even if you buy something that you're buying it in place rents of 5, market's 10, yeah, you can double the rents. But if the WALT is 5 years, then you're going to have to carry that thing underperforming for five
Yeah,
years before you can get there. So
that makes
that's one of
sense.
the big factors we look at, and just kind of just putting it all together in a model. I mean, it's kind of hard. We don't really have like a, hey, if we can buy it at this cap rate and get it to this cap rate, it'll be okay, primarily because of that carry piece. So every deal is a little bit different, but it really just comes down to if we can buy it, per square foot. Sorry, if you can buy something for $100 a square foot and market rents are $11 or $12 a square foot, then you're going to be able to stabilize to 11 or 12 yield on cost. That's kind of a back of the napkin thing that we look at a lot, and then kind of dig in from there. Because if we're
Right.
looking at something that's $120 a square foot and market rents are 8, you're going to stabilize to a 7%. That's not going to work with 8% debt. So that's a big thing that we look at is price per square foot versus market rent to kind of start
There
off.
you go. And then what are you telling these brokers is kind of your buy box?
So really 30 to 200,000 square feet foot complexes need to have some sort of upside. 90s or 80s vintage or early 2000s, but really 90s and 80s is when a lot of this was built.
Mm.
We like to be in more stabilized markets, like I was saying, like a Birmingham, Alabama, million people in the MSA. It's never going to be Austin, Texas, but it's, there's a million people there. It's enough of a city. And then we want to be kind of in the hotter suburb areas. So a
Mm.
lot of our tenant mix will be HVAC companies, kind of last mile logistics kind of stuff. But a lot of times you want to be more in the affluent areas of town, because your business owner who owns that HVAC company is going to live in the affluent area, and he wants to have
Mm.
his office warehouse near where he lives. So there's growing pockets even within those kind of stabilized markets that we want to be in. So yeah, 30 to 200,000 square foot complexes total. A lot of what we buy is really more in the 50 to 150 range, but we'll go higher and lower. And then, yeah, just upside in rents is really the biggest thing. We're fine doing renovations. We don't mind redoing stucco, replacing roofs, redoing parking lots. It's all pretty typical for us. Redoing landscape. I feel like industrial, sometimes people forget to do the exterior kind of beautification stuff and kind of makes things a little bit nicer. I mean, multifamily, obviously, multifamily does a really good job of doing that. But in industrial, people are like, it's industrial real estate. Who really cares? But it's still where people go to work every single day, and people want to go to a nice place, right? And I think that's kind of universal in real estate. If you can make something nicer, usually you can charge more rent for it.
Yeah, yeah,
Yeah.
absolutely. Okay, so then, and then in terms of like putting the deals together, how are you funding your deals right now?
Yeah, so we started off in syndication world, so raising money kind of deal by deal. So I think our first deal we raised $1 million from 9 people, and
Hmm.
50 and $150,000, 50 and $100,000 checks.
Nice.
And then we got into the fund world more now, though. So we launched our first fund, SCP Industrial Holdings One, last fall. Started closing our first deals on that fund here in Q1 of 2024. So that fund is invested in 3 deals: one in McDonough, Georgia, Louisville, Kentucky, and Jackson, Mississippi Metro. It's about 376,000 square feet that it's invested through. We will fund our deals a little bit more unique, though. We'll use our fund and then bring in a JV partner, kind of pari passu, to go buy something. So, for
Mm.
instance, that deal in Jackson, Mississippi Metro was 158,000 square feet. Total equity need was about 7 million. We brought a check of about 6 million from one large family office, and then brought in our fund for the remainder to kind of be able to invest alongside each other. It allows us to be able to scale up our fund, but also get our fund into larger deals,
Yeah,
but not putting too many
smart.
eggs in that basket. Yeah. Because, I mean, in a
Yeah,
perfect world, we would go out and raise $200 million in equity, but it's our first fund and we're still new. And that's not really in the cards right now. So being able to kind
yeah,
of pair up both of those, because we've also found that, your a lot of smaller investors that are maybe $50,000 to $250,000 checks. They like funds because they can get a lot of diversification with that kind of money. But the large check writers that are writing checks of 3 to 10 million per deal, they want to be in one single deal. That's usually going to be sub-institutional, large family office. So kind of being able to marry those up together, I think is important, just because I feel like a lot of firms will kind of go, we're retail focused or we're institutional focused, and kind of being able to do both has been helpful for us. Because we need all the equity people can throw at us, so might as well do both, right? So don't want to turn
No,
anybody
that's
away.
smart. It's a smart way to do it. Yeah, it's a good way
Yeah,
to do it.
we've
Very
enjoyed it.
cool. And then what about like your exit strategy on these deals? What are you guys looking at on that?
Yeah, so there's other PE shops that we would sell to, other just kind of more general local investor groups that will buy these. In a perfect world, I would love to say, hey, we're going to bundle all these up throughout the Southeast and sell them to a large institution. Currently, the market is just not there for that. Like, you saw that happen in self-storage. You've seen that happen in multifamily, where people will go just aggregate 100 deals throughout the Southeast and sell them off to one large institution. Currently in Flex, that buyer does not exist. In 5 years, when we're exiting this first fund, maybe it does. But right now, I believe it's just selling to someone who's more of a stabilized investor. And there's a lot of them out there that would love to own this at a stabilized cap rate, clip coupons, and not really have to do that upside lift. But
Yeah,
that's who we see
exactly.
exiting. Mm-hmm.
Yeah, they just want to buy something that's done. You know, you've
Yep.
done all the renovations over the 5-year period. You've got it rented up. There's strong tenants in place. And then that, someone like you said that just wants to buy it, sit on it, and collect checks can do that.
Yeah, and our deal sizes are pretty small. I mean, most of our stuff's we've done some $15 million deals, but for the most part, they're more 5 to 10 million. And even on sales prices, they'll be in that $5 to $10 million range. That's not too large that you wouldn't see like a group of 5 to 10 local businessmen in the Atlanta metro buy a deal from us, kind of thing. So it is a little bit bigger than kind of your more mom and pop, but not so big that it's like, hey, we have to have an institutional buyer when we exit this thing.
Yeah, no, that makes sense. Um, and then on the raising money piece, how are you guys finding your investors and kind of pitching them on getting in your fund?
Certainly. So we do a decent amount of online stuff. It's kind of a newer avenue for us. We go on podcasts, obviously. We also do some social media advertising. Do some webinars. Just try to put out as much content as we can. Right. Just try to make sure that people know what we're up to, and that's mainly through online. We're again located in South Alabama, so it's not like we're in a huge market where you can just kind of go to real estate meetups and meet hundreds of people that are invested in real estate. It's a little bit more going to be an online presence, which is great though, that in 2024, we can live in a small town and still be able to do what we do and have enough of a presence through the internet to be able to raise capital. But we do, our larger checks, we kind of use more brokers on that. There's large scale equity brokers that do kind of that larger institution, sub-institutional kind of equity. And then on the retail stuff, it's a lot of networking and just kind of talking to existing investors. Doing a really good job with your current investors leads to new investors later on, just because people will tell their friends about what you're doing. So we make sure that we're networking with our current investor base a lot. We do kind of local meetups in markets that we play in. Like, we own a lot in Jackson, Mississippi. We'll do cocktail hours and dinners and stuff like that when we go to town. And really just grassroots networking, because that's really who people want to invest with, is people that they know, people that they can call and talk to. And so we do that, some of that, again, online advertising kind of stuff that gets people to us, but also just kind of being in the market and letting people know what we're doing.
Tell me a little bit more about that social media stuff that you're doing that's working.
Yeah, so we have a company that came to us. It's a marketing firm, and they run mainly Facebook and Instagram ads through Meta. And it just kind of gives a highlight of what we do, and be able to say, this is the return structure, return goals. We're buying multi-tenant flex industrial, accredited investors only, if you'd like to learn more, kind of thing. And I've seen good deal flow or good lead flow through it. I mean, it's just like any lead generation. Obviously, it's a numbers game, right? You're going to convert a small percentage of them, but it's a great avenue to allow us to be able to get into advertising in markets like out west, or bigger cities, or places where we wouldn't typically know people. It's a really good thing for us.
Yeah, no, that's very cool. Um, I like that. So you're just paying an agency and they're basically generating leads for you.
Exactly. And that's what they do.
Nice.
And they do it just for real estate. It's really interesting. And then on top of that, just kind of more traditional marketing. So we also have a, like a normal third party marketing firm that does like our typical social media ads, like our normal, or not ads, I'm sorry, normal posts, blogs, videos. That's just really one of the biggest things. So, like, I've obviously seen a lot of your content throughout the internet. And I think that that's something we lacked at the beginning. That's been a really big push for us in the past 6 months, because you can be a great fund manager, but if nobody knows what you're doing, that doesn't really help anybody. So you need to be sure
Yeah.
to be out there. And it's a little bit hard, right? It's not super comfortable to always put yourself out there and post stuff and let people know what you think, but it's important and it shows authenticity for sure. And this great thing again about the internet is that someone can look you up and kind of get somewhat of a feel of who you are, what your morals are, what you're trying to do, just based on your content that you put out there. So that's a big thing for us these days.
Yeah, that's very true. We call it's your virtual business card because
Yeah,
nowadays, like, if you're going to do business with someone, there's a 100% chance they're going to look you up. At the very least, they're going to Google your name or your company or whatever. And to not have anything there is just not a good look, or, only a website. But if you've got all your profiles and you've got videos and you've got this and that, and like you said, then people can do a lot more due diligence, get to know you kind of before the the transaction takes place.
100%. And I think that also, I mean, like you said, every email that I get that's cold or something like that, I immediately go to the bottom of their signature and click on their website to see what they do. It's also just interesting to find different avenues that people are making money and doing deals. And so
Yeah.
it's fun to track that. But yeah, 100%. You can get feels like a pretty good understanding of who someone is, just through the content that they put out there and kind of what they say and how they hold themselves.
Yeah, absolutely.
Yeah.
Absolutely. So back to these kind of flex industrial deals. Why don't you
Mhm.
talk to me about like the ratio of like how many deals you're looking at versus how many deals you're making offers on versus how many deals you're getting under contract?
Yeah, let me look at this real fast. I had my analyst pull this information the other day, actually, so this is convenient. Um, but he had on there, I guess last month, he underwrote, I think, 40 deals is what it looked like. We made offers on two or three of them. I don't think we put a single one of them under contract. So that's just last month. But for the most part, we'll look at, I'd say, 100 a month. We'll underwrite 30 to 40 of those. And then we'll make offers on three to four of them, hope to get one of them under contract. Is kind of
Yeah.
the current model.
Yeah, but
Um,
even to your numbers there, 40, 40 to one deal is not too bad.
No, it's not. And a lot of that just comes down to the fact that when you specialize in one thing, you can kind of quickly figure out if it's going to be worth it or not. Like I was saying, that per square foot purchase price to market rents, that one's really easy to be able to quickly shuffle through some, which you have to be careful with as well. You don't want to get it too kind of, I guess, negative to the point where you're like, that one's not going to work, that one's not going to work, because there are some hidden gems in there. You need to make sure that you really understand what you're casting to the side, because finding good deals is hard. So you want to make sure that you're
Mhm.
looking at every stone that comes down your way. But yeah, we look at a lot of deals, get a few under contract just to be able to buy the best ones.
And are you mainly looking at deals kind of in your current market, or are you expanding outward as you grow? Or what do you recommend there in terms of, staying focused on one area versus expanding the net?
Yeah, and so fortunately, Jeremy and I from our brokerage world, we're doing stuff kind of throughout the southeast. So like, I've done deals in Birmingham, for instance. So like, I understand the Birmingham market to a certain degree just from that. We don't currently own anything there, but would like to. But yeah, so we currently own stuff, I guess, in Arkansas, Mississippi, Alabama, Georgia, and Florida. We would like to expand more into potentially Louisiana, some parts of Texas, and then up into the Carolinas. So yeah, we are definitely looking to expand kind of that area. We do. My business partner always likes to call it the SEC region. So if there's an SEC school there, then that's usually the kind of state that we'll go to. That's usually a growing state, Southeast. We understand the markets, that kind of thing.
Nice.
So yeah, we would like to expand out a little bit more, but just because of the fact that in secondary markets, there's only so much supply. So you got to have multiple geographical locations to be able to do that.
Yeah, no, that makes sense. And then obviously you got to go and connect with the brokers and do all the stuff that you had mentioned there. Very cool. What about like tech stack or any of your favorite tools, softwares, apps that you guys love?
Yeah, so we use CRE models to underwrite with. It's an Excel add-on that has a lot of tech enabled to it to be able to pull demographics very easily, that kind of thing. We use CoStar. CoStar's not always the best data, to be honest with you, but it's at least geographically all over. So everywhere does have some sort of data through CoStar. We use Land Vision a decent amount for kind of our mapping software and GIS. Trying to think what else we use a lot. Those are really the main three that we use every single day.
Yeah, no, that's good. And what did you call that Excel bolt-on?
CRE models.
CRE models. Cool.
Yeah, so
I'll have
they
to
have
check
a
that out.
yeah, so they have kind of pre-built out models to where we're pretty decent in Excel, but they have a team of engineers that if you need to have a very distinct model built, they can kind of do that for you. But they have a good templates of land acquisition, multifamily, industrial, kind of whatever development and acquisition models in there. That makes a really good suite. We really like it.
Nice. Yeah,
Yeah.
that sounds great. Well, very cool. What about just kind of as we're wrapping up here, what would you say, in 60 seconds or less is the key to being good at this type of investing with the flex industrial space?
I think the biggest thing is being able to be disciplined and knowing seeing the writing on the walls. I mean, you can kind of convince yourself that any deal is a great deal or any deal is a bad deal, but being able to be really honest with yourself and saying, yes, if we could get rents to $14 a square foot, this thing would be a slam dunk. And this one building, this one time got those rents, so maybe the whole market's going to go there. Well, that sounds great. If you really look at it, in your heart of hearts, that is not the case. And it's hard because, I mean, obviously we make a living buying deals. That is how you do things. But your investors trust you to do just good deals. And you need to make sure to stay disciplined on that, not get over your skis, and to kind of believing stuff that they can't really come to fruition. I think it's your biggest thing.
Yeah, great advice. Well, right on, Grant. I really appreciate your time, man. For those that want to learn more or connect with you or potentially invest in your fund, how
Yeah.
can they find you?
So our website is Stoic, STOICEP.com. My email is greaves@stoicep.com, and Reeves is REAVES. I'm also on Twitter. I don't post as much as I should, but I'm on there. Reeves_Grant. And then I'm on LinkedIn. I don't know my LinkedIn tag, but you can Google me or search me, and I'd love to connect with you there too. So
Right on. That's a great way to do it. Well, once again, man, I really appreciate your time. And for everybody out there, as always, if you like money and you like real estate, hit that subscribe button, like the content, and we'll see you on the next one. Thanks, Grant.
thank you for having me.